All right, let's talk about something that's super important for your NISM exams, alternative investment funds, or AIFs. You've probably heard the term thrown around a lot, right? But what are they really? Well, today, we're going to pull back the curtain and break down the core concepts you absolutely need to nail.
So here's the game plan for today. We're going to start with the basics. What even are AIFs? Then we'll dive into the super important SEBI rules you've got to know. From there, we'll look at the three main categories they fall into, check out some specific types of funds, and wrap it all up by figuring out why any of this matters for a real-world portfolio.
Okay, first things first. To really get a handle on AIFs, we have to start with that first word, alternative. What does that even mean? What makes an investment alternative compared to, a normal one?
And really, it all boils down to this one simple comparison. On one hand, you've got your traditional stuff, stocks, bonds. You can buy and sell them easily, right? They're liquid. They're for everybody. But alternatives, they're the complete opposite. Think of them as off-market deals. They're not easy to cash out. They're illiquid. And that complexity, that lack of easy access, is precisely why they're meant for really sophisticated, high-net-worth investors who know what they're getting into.
Okay, so that brings us to the official definition from SEBI, and you'll definitely want to remember this one. SEBI calls an AIF a privately pooled investment fund. Now, those two words, privately pooled, are everything. It means this isn't for the general public. It's a club, a select group of investors, and it plays by a totally different set of rules than your everyday mutual funds.
All right, so now we know what they are. Let's talk about the rules of the road. SEBI has set up a really strict framework here. And trust me, for your exam, knowing these specific numbers is an absolute must.
Okay, SEBI's framework is all about a few key numbers that basically act as gatekeepers. First up, you can't just start an AIF with pocket change. Every single scheme has to have a minimum fund size, a corpus, of at least 20 crore rupees. That's the entry ticket.
Next, to keep things private and exclusive, there's a hard cap on the number of investors. You cannot have more than 1,000 investors in a single scheme, period.
And the third rule, the price of admission for an investor is steep. You need to put in a minimum of 1 crore rupees. So you see, when you put these rules together, the huge fund size, the small number of investors, and the high minimum investment, it makes it crystal clear these are not for your average retail investor. And just to double down on making sure only the big players are in the game, SEBI came up with this concept of an accredited investor. Basically, it's a special class of investor if you meet these really high financial benchmarks like, an annual income over 2 crores or a massive net worth. Then the regulator basically says, okay, you probably have the financial know-how to handle the big risks that come with AIFs, so you don't need all the same protections a small investor would.
So, you can imagine the world of AIFs is pretty huge and complex, right? Well, to make it easier to understand, SEBI has helpfully sorted them all into 3 main categories, and it's all based on what they invest in and what they're trying to achieve. And this table, this is a fantastic summary of the whole AIF universe. Let's break it down. First, you've got Category I. Think of these as the funds that are good for the economy. They're backing startups, SMEs, social projects. The government likes these, so they often get special incentives. Then there's Category II. This is kind of the bread and butter category. It includes things like private equity and debt funds. The key here is no leverage and no special government perks. And finally, Category III. This is the wild side. We're talking about hedge funds that use really complex strategies, a ton of leverage, all to chase short-term returns. So you've got the socially desirable, the standard, and the sophisticated. Okay, so now that we have those 3 big buckets, let's zoom in a little and look at some of the actual types of AIFs you're most likely to hear about. First up, the famous venture capital funds, or VCFs. These guys are squarely in Category 1. You can think of them as the rocket fuel for new ideas. They're the ones writing the early checks to startups and brand new companies, long before those companies are big enough to be on any stock market. All right, next up, private equity, or PE funds. Now, these are in Category 2, and here's the key difference from venture capital. PE isn't about funding a brand new idea in a garage. They invest in companies that are already up and running, already successful, but are still private. They come in with capital to help that solid business get to the next level, maybe expand, or just get more efficient. And now for the big one, hedge funds. These are the classic example of a Category III AIF. For hedge funds, it's all about using every tool in the toolbox. We're talking complex trading strategies, using leverage to amplify bets, and diving deep into derivatives.
Their goal is to make money in the short term, no matter which way the market is heading.
Then we have AIF debt funds, which are a huge part of Category II. The easiest way to think about these is that they act like private banks. They lend money to companies, especially to those who might have a hard time getting a loan from a regular bank. And in return for that loan, the fund gets to collect interest payments. Simple as that. And last but not least, infrastructure funds, another type of Category I AIF. These funds are all about building the big stuff. They invest in the massive, long-term projects that our entire economy depends on. So think new roads, airports, power plants, stuff that takes years and years to build and requires a ton of patient capital.
Okay, so we've covered a lot of ground. We've got the definitions, the rules, the categories. But let's take a step back. What's this so what? Why would any serious investor or portfolio manager bother with all this complexity? What's the point of adding AIFs to a portfolio?
Well, at its core, it really just comes down to one thing: the hunt for higher returns. I mean, let's face it, we live in a world where economic growth can be sluggish, and the interest you get from safe investments is often pretty low. So your standard stocks and bonds might not be enough to get you where you need to go. AIFs open up a whole other universe of private, off-market opportunities that could potentially deliver those higher returns.
So here's the absolute key takeaway you need to remember. AIFs are not meant to replace your traditional investments. Think of them as a complement, a strategic addition. Yes, they can give you great diversification and potentially higher returns. But, and you can't forget this part, there's a big trade-off. That potential comes with way more risk and the fact that your money is going to be locked up for a long, long time. It's the classic risk-reward equation, just on steroids. Which really leaves us with the final question to chew on. As the financial world keeps getting more complicated and everyone's searching for better returns, are these alternative funds a novelty, or are they becoming a necessity for any truly sophisticated investor? That's a big question, and one the market is answering every single day.